Thank you, Miami. Thank you, the University of Miami, for this opportunity to present this work. It's a treat to be able to, in this environment, present work and get feedback. This work is co-authored with Pei Li and with Leo Tang, and they're joining our workshop and they're taking notes. So your comments will be most welcome because this work is still under construction. We scrambled to get this version of the paper to you all. And so we look very much forward to your feedback. So I want to talk about credit ratings and cheap talk. So credit ratings have this feature that it has a very coarse message structure. So for instance, the ratings may be AAA, AA1, all the way down to CAA3 in the case of Moody's. And if we look at S&P, they have a similar coarse rating system. And despite the fact that they have this coarse rating system, investors still find credit ratings useful. One wonders why, and there is an interesting theoretical paper by Gold and Thakor in the JFE in 2015, and they use a cheap talk model to rationalize the usefulness of these coarse ratings. And when we use the word cheap talk, the question is, what do you mean? And it means that the rating is costless. So in other words, whether you use the words AAA or AA1 or BBB, those words don't have any real meaning. We could have used a rating system, red, blue, green, etc. And that in some sense would convey the same information. So the words that we use are costless. And then importantly, they're also unverifiable. And so what we want to do in this paper is we want to examine the informational properties of credit ratings and to see whether they are appropriately described as being cheap talk. Now, why is this important? It's very important for regulators to understand the properties of information when regulating. For example, if information is unverifiable, say for instance cheap talk, then the regulator's primary concern has got to be with incentive alignment. In contrast, if information is verifiable, then even though incentives are misaligned, and even though it's common knowledge that incentives are misaligned, you can still get full revelation, provided, of course, we understand what those incentives are. So you can appreciate then, by understanding the properties of information, it's got dramatic consequences for how we regulate, and we'll talk more about that. Okay, so then the question arises, can the cheap talk framework be used to describe credit ratings? Well, on the one hand, we think of information as being unverifiable. For example, John Coffey, in his book called Gatekeepers, he looked at credit rating agencies and he argued that they enjoy virtual immunity from private litigation. Also, strikingly, credit rating agencies enjoy First Amendment protection. So their opinions are protected as free speech. That differs from the protections that other intermediaries like public accountants or security analysts might enjoy. In fact, there was this interesting article in the Columbia Law Review by Caleb Dietz, and the title of the paper is Talk That Isn't Cheap. So it's recognized in the legal literature, this notion of cheap talk, and they go into length discussing whether this information is verifiable or unverifiable. And Dietz would argue that this information is unverifiable. So these are arguments then arguing that this talk is cheap, but there are reasons to think that this talk is not that cheap. For example, the First Amendment protections that the credit rating agencies, we'll call them CRAs, enjoy, it's a function of whether their communication is of public concern or not. So how broadly are these ratings disseminated would have implications for the credit rating agency's ability to invoke a First Amendment defense. Another issue is it's very difficult for us to assess the accuracy of credit ratings, but nevertheless, they can be evaluated over a period of time. And so that then would raise some questions about the verifiability of their ratings. The Credit Reform Act of 2006, it authorized the SEC to develop rules that can be used to enforce rating quality. For example, it required that the rating agencies come up with performance measurement statistics over the short, the medium, and the long term. It also requires that they have a code of ethics to ensure that the disclosure is verifiable. So these are arguments that would argue that these credit rating agencies ratings are in fact verifiable. And then the Dodd-Frank Act of 2010, it further heightened the penalties that credit rating agencies might face. For example, to facilitate transparency, the Dodd-Frank Act argued that the rating agencies must publicly disclose their rating methods and the data that they use so that investors can evaluate these CRAs. So these would be arguments that would suggest that this disclosure is in fact verifiable. So you can see here, there's a bit of a tussle. Does the cheap talk framework de facto to describe the institutional environment in which credit rating agencies communicate with investors? They might enjoy First Amendment protection, as Dietz has argued and as legal theorists have argued, but the question is actually an empirical question. So against this background then, we're going to explore two primary hypotheses. We first hypothesize and find that more favorable credit ratings are increasingly less informative to investors. And this is a somewhat striking result. One might think that if you get a AAA rating, and this is a really healthy Muni bond, that you should be pretty informed about that municipality. You might be able to feel quite comfortable valuing that bond. But our hypothesis and our findings are that as these ratings become more favorable, they become less informative. Now, to sharpen our tests, we look at the Moody's 2010 Muni bond recalibration. What Moody's faced was they saw an increasing number of investors that were investing across different asset classes. And outside of the Munis, they had a different rating scale for corporate bonds. And so after some pressure, from their investment community, what Moody's decided to do was to apply a common rating scale across both municipal bonds as well as corporate bonds. So we're going to look at this event, and in the context of this recalibration, we hypothesize and find that after this recalibration, the relationship between the informativeness of the rating and the favorableness of that rating, that relationship actually gets stronger after that recalibration. And so these are, as we shall show you, these are two predictions that fall out of a verifiable information model that you wouldn't get if we had a verifiable information model in place. Okay, so what are our contributions? We have three key contributions. The first contribution is credit rating agencies are cheap talk. So the legal theorists have argued that they are cheap talk, and empirically, we offer some evidence that they are in fact cheap talk. Now, why do we think that this is important? As you know, there's been a great deal of work that has invoked the cheap talk framework. We've invoked it in the context of firm voluntary disclosure. These are theoretical models in the context of firm voluntary disclosure, in the context of credit ratings, in the context of earning equity analyst communication. If you think about equity analysts with their buy, hold, sell ratings, it looks a lot like those ratings that the credit rating agencies offer. I have a paper on polling with John Morgan in the American Economic Review, where we also have used this cheap talk framework to explain polling behavior. But more generally, it's been used to describe sort of ordinal information, so information that can be ordered as opposed to a cardinal ranking. Despite the widespread use of this framework, we're not aware of any large sample empirical work that is established whether the cheap talk model describes the behavior of information intermediaries. Sure, there's been work in the labs, but we're not aware of any work, empirical work in capital market settings that establish whether this cheap talk framework is actually descriptive or not. So we view a contribution of this paper as an important one in that we establish that the key assumptions underlying the cheap talk model, namely costless disclosure and unverifiable reporting, they do describe the debt market setting. And we think that's pretty cool. The second setting, if we understand the properties of the information, then it has important implications for how we regulate the providers of that information. So if it is in fact cheap talk, as we're going to argue, information breaks down when you have a misalignment of incentives. And so therefore the focus of regulators has got to be on ensuring there's an alignment between the credit rating agencies and the investors. So, for example, to enhance that alignment, what regulators might want to do is they might want to revisit the issuer pay model, because like auditors, for instance, the credit rating agencies are paid by the issuer, by the municipality or the corporation. And of course, that gives rise to some conflict. And so I think it's appropriate that the regulators currently are investigating the issuer pay model. Indeed, the head of S&P's Global Rating Services claimed that this issuer pay model, or this business model question that's currently being debated, is existential for them. So if we can offer some guidance to regulators as to where they should focus their attention and how forcefully they should focus their attention, we think that would be a useful service that we as academics can provide. So if information is non-verifiable, if it's cheap talk, the focus has got to be on aligning incentives. In contrast, if the talk is verifiable, as may be the case, for example, in analysts' earnings forecasts or management earnings forecasts, or management disclosure, voluntary disclosure more generally, if that disclosure is verifiable, then the focus has got to be on ensuring that the incentives are well understood. Even if it is common knowledge that the interests of the analyst and investors are conflicted, provided we understand that conflict, then invoking Grossman and Milgram's insight, we can get full revelation. Or even in a costly signaling model, a la Stein 89, you can get full revelation, provided we understand the incentives. So hence, the recently issued regulation best interest that the SEC voted on in June of last year, where they argued that financial advisors need to disclose their interests if they have equity interests in the firm that they're recommending to a client, for instance. That resolves the problem if information is verifiable. If, in contrast, information is unverifiable, then a regulation like best interest doesn't hold because it doesn't align incentives, which are vital. Sure, it makes clear that there's a conflict, but that's not good enough for cheap talk. You need to align the incentives, because the difference between verifiable information and unverifiable information is just how fragile information is when we have unverifiable information. And so therefore, incentive alignment becomes really important for unverifiable information. Okay, so that's the second key point. The third key point is we look at investor sophistication. We partition our sample into retail investors and into institutional investors. And we conjecture, this is exploratory, but we conjecture that institutional investors are much more likely to be aware of the strategic reporting incentives of the credit rating agencies. And therefore, they're much more likely to respond to this disclosure, recognizing that it is unverifiable, as if it is cheap talk. Whereas we conjecture that retail investors are less likely to be, or less likely to recognize the strategic reporting incentives of the CRAs. And what we find is that institutional investors do behave as if credit ratings are unverifiable, as if it's cheap talk, whereas retail investors, in contrast, behave as if the information is verifiable. So the institutional investors are quite different from retail investors in terms of how they recognize the properties of the informational properties of the credit ratings. And of course, then, this has implications for regulation, because here again, regulators could provide a service to protect the less sophisticated retail investors by trying to align the incentives of the issuer with those of investors by, for example, revisiting the issuer pay model. So those are our three contributions. In terms of the antecedent literature, we've benefited greatly from the antecedent literature. And there's a fairly vast now antecedent literature that has looked at the Moody's recalibration, both in accounting and also in finance. While we do build on this literature, our focus in this paper is quite different. Our focus is trying to understand the properties of information. And we view this setting, the 2010 Moody's calibration, as an ideal laboratory within which to examine the properties of the cheap talk model, which, as I mentioned earlier, have not been examined in any large empirical study. So we're going to argue then our distinct contribution relative to this work is to establish that the cheap talk model not only is hypothesized, it's posited to explain the properties of the credit rating agencies, but also de facto, empirically, it explains those properties. Okay, so with that said, let's turn to our hypothesis development. And here you're going to have to excuse me. When Leo and Pei first started to talk to me about this paper, I thought this is a paper that I wanted to be involved in, because for 20 years I've used cheap talk models, but always theoretically. And I've always wondered about just how institutionally descriptive these assumptions are. And so this opportunity to study it within the context of this work is just really, it's just been a delight for me in terms of thinking more fully about how we model the world. So to offer a hypothesis, what we will do is let's talk about an unverifiable information setting. And then after that, we'll talk about the verifiable information setting to show that there is in fact a credible null hypothesis here. Now, with regard to unverifiable information, of course, unverifiable information, this work began with the seminal paper by Crawford and Sobel back in 1982. They introduced the cheap talk model. And what are the key features of the cheap talk model? The key features of the cheap talk model are that you have a sender and a receiver. The sender sends a costless, unverifiable signal. The receiver then takes an action that affects the payoffs of both players. And this model has been used, as we mentioned earlier, in the finance literature to explain credit ratings. Okay, so let me introduce just a very basic cheap talk model, and I'm purposefully trying to borrow the work of Crawford and Sobel. I don't want to add bells and whistles because we want to explore the most basic elements of the cheap talk model within this empirical laboratory. So let's consider a world where you have a credit rating agency that offers a forward-looking opinion about the credit risk of some municipality. And as all of the credit rating agencies, Fitch, Moody's, S&P, they all state that they are offering an ordinal ranking, not a cardinal ranking. So as a consequence then, we think of the credit rating agency as observing some random variable theta, and let's think of it as being uniformly distributed on the unit interval. You could think of it as a percentile ranking of the students in your class, and you're just going to be ranking the students. Okay, so the underlying observation here is theta. It's privately observed by the credit rating agency. It's uniformly distributed on the unit interval. The credit rating agency privately observes the ranking of the municipality that's issuing the bonds and then issues a signal. Let's call it R, a rating, to investors. And as mentioned earlier, this rating can be vague. It can be AAA, it can be BB minus, it can be blue, red, green. Moreover, you can even try and mislead the investors if you wanted to. Investors will then hear that rating and then form an expectation about the price of the bond or the yield of the bond. Okay. Now, importantly, to understand how we got to our hypothesis, we need to think about what is the objective function of the rating agency. And we use this objective function, which is being used in other settings as well. The first term reflects the incentives of the credit rating agency to boost the price of the bond. And the reason for that is because you want to carry favor with the municipality that's issuing the bonds or with the corporate bond issuer. You want to carry favor. But on the other hand, you are also concerned about your reputation or regulation. And so you don't want to issue a rating that's too far removed from the underlying theta. So you can see the second term there reflects this quadratic loss function. So sure, you push up the rating, but you bear this cost associated with issuing a rating that's too far removed from the fundamentals. Okay, so what does Crawford and Sobel say? In a cheap talk world, the equilibrium is partitional, like the rating system that we see the credit rating agencies being used. And importantly, there are a finite number of messages that can be issued in equilibrium. So that's a key feature of a cheap talk model. There are only a finite number of messages. The number of messages, of course, are a function of alignment. If interests are highly aligned, there'll be more messages. If there's a misalignment of interest, there'll be less messages. Okay. And then the rating agency would issue a report if the theta lies on some interval, and then the investor would update the investor's beliefs. Let me show you that graphically. Okay, so imagine that on the x-axis we have the credit rating agency's information, and if the municipality is ranked, say, somewhere between 0 and A1 in terms of percentile ranking, then the credit rating agency would issue the AA2 rating. In contrast, if the municipality is much more highly ranked, say somewhere between A2 and A3, then the rating agency offers the AAA rating. That then translates into how the bond is priced. But notice that there's this coarse message structure, and then there's a coarse number of actions that you induce. Now, for our hypothesis, notice as well that as the ratings get more favorable, so the precision with which the credit rating communicates the underlying ranking of the issuer declines. And you can see that if you look at just the range from A1 to A0, that's a much shorter range, for instance, than if you look at the interval from A2 to A3. And what's the intuition here? Of course, the municipality wants to issue higher and higher ratings because that would yield a higher price. So if we look at this formula that I've given you where you have this inequality, by offering a higher rating, you're going to induce a higher price. Well, suppose you observed a state of the world where you should have issued the rating AA1. If you issue the rating AAA, you will get a higher price and thereby curry favor with the municipality. But what will stop you from offering that more favorable rating, AAA? Well, you can see that if you should have issued an AA1, but you go ahead and issue the AAA rating, the only way you're going to be discouraged from sending a message that is too favorable is if that cost structure, if that cost function, that quadratic term, gets higher and higher. And how do you make that cost function higher and higher? You increase the level of dispersion. So the point here is, as ratings get more favorable, so they get less informative about the underlying state. So that then leads us to our first hypothesis. We define dispersion as just being the variance in the yields given a rating, and we look to see how the dispersion varies in the favorableness of the rating. And we say, let's fix a rating system, and we hypothesize that the dispersion will increase in the favorableness of the rating. Okay, now of course you can appreciate here we fixed the rating system. Well, there's no reason, and we know that Moody's has a different rating system from Fitch and from S&P. And moreover, Moody's changed their rating system. So to show, and we see this in this figure, you can see how when Moody's in 2010, they shifted their rating of municipal bonds. They used to use sort of the entire scale, but then as they face pressure from crossover investors, they moved towards using the global rating system for all of their bonds, both corporate and munis. And as a consequence of that shift, they didn't use those lower ratings at all because municipalities just don't fail with the same frequency, for instance, that corporates fail. And so we view this as being a decrease in the cardinality of the number of ratings that Moody's actually uses. So what are the implications of that? So consider the green line. So that's the figure that we looked at earlier, where there were 3 ratings that were offered. Now let's, for exogenous reasons, just reduce the number of ratings and suppose that there are only 2 ratings that we offer post-recalibration. And what you can see is if you look at the picture, you can see how when you jump from AA1 to AAA, you can see how the dispersion goes up. But when you jump in the red figure from AA1 to AAA, you can see the dispersion goes up by even more. So post-recalibration, we therefore hypothesize that there will be a stronger relationship between dispersion and the favorableness of the rating after the recalibration relative to before the recalibration. Okay, so that's a cheap-talk model. What would you get in a non-verifiable setting? Sorry, I misspoke, in a verifiable information setting. So in short, is there a credible null hypothesis here? So here we go back to the famous work by Grossman and Milgram, where they argued that if a sender discloses, the sender must disclose truthfully, but of course the sender can withhold information. And we see this assumption in work by, the seminal work by Vareka 83 or Dye 88, and many, many other work in accounting where they use this assumption in the persuasion game literature. So notice here, even though there is a misalignment of incentives, even though the sender, the rating agency, or the equity analyst, or the seller of a car, even though the seller's interests are not aligned with those of the buyer or the investor. In fact, the seller might want you to value the car or the object at the highest possible value, even though there's a misalignment. Milgram and Grossman established that full revelation results in equilibrium. So credit rating agencies, they would have a very different rating scale if their information was verifiable. Okay, so with that said, let's now fix the number of categories in this verifiable information model. Now, I know that full revelation is possible. There's no reason to, but to align it with the course rating system that we observe, let's fix the number of categories. And what you find here then is that we can characterize what the optimal message system is. And the optimal message system is for the credit rating agency to partition the scale so that each rating occurs with the same probability. So if I draw a picture, you can see here, so suppose we have 3 ratings, AA2, AA1, and AAA. Each of those ratings will occur with the same probability under a verifiable information model. Okay, so in terms of our hypotheses, there should be no relationship, if information was verifiable, between dispersion, which is how the investors are reacting, and the favorableness of the rating. Looking at H2, it's true that when Moody's recalibrated their debt, by reducing the number of categories, dispersion would have increased for each of the ratings, but it increases equally for each of the ratings. So therefore, after the recalibration, there should not be a relationship between the favorableness of a rating and the dispersion in the yields. So that both of these two hypotheses stand in strong contrast to those that you would get if you assumed that information was unverifiable as in the cheap talk setting. So let's look at the data, and I guess I've got just a few more minutes and to see what the data tells us. So we look at Moody's, which we use as a treatment group, S&P, which we use as a control group, and we look at a sample period around Moody's recalibration, a year before the Moody's recalibration in April of 2010 to a year after the recalibration. We grab some bond trading information from the MSRB database. We grab some bond information from the Mergent database. So in terms of our sample, we have around 7,200 observations. About half of those relate to Moody's and about half of those relate to S&P. And these are bonds that are only rated by Moody's and only rated by S&P. Okay, so in terms of our research design, we will offer 2 research designs. Let's first of all look at H1. So remember, H1 said that as the rating gets more favorable, so dispersion should increase. So if we have as our dependent variable dispersion, which is the standard deviation of yields by week for a given rating level and a given maturity level. Okay, so that's our dependent variable. And let's regress that onto the main effect rating, which is an ordinal scale from 1 to 10, where 1 is the least favorable rating and 10 is the AAA rating. Let's look at recalibration as a indicator variable taking on a value of 1 after Moody's recalibration in April of 2010 and 0 beforehand. And then Moody's would be an indicator if it's a Moody rated bond, 0 if it's an S&P rated bond. Okay? And what we would predict in a cheap talk model is that as the ratings become more favorable, so the dispersion should increase. And how would we see that? We would sum the coefficients on the interactive effect between rating and recalibration. So that would be beta 1 plus beta 4, which would be the coefficient on rating. And what do we find? If we look at our data, we do indeed see that the sum of those 2 coefficients is in fact significantly positive, which is consistent with a cheap talk model, not with a verifiable disclosure model. Okay, now what about H2? So H2 is far more subtle, and so it takes a little bit more empirical machinery to expose H2. But H2 says, after Moody's recalibration, that relationship between the rating and the dispersion of yields should be more pronounced. So how are we going to test that? Here we're going to have a triple way interaction. Once again, we have dispersion as our dependent variable, and we regress it on those 3 main effects, but now we're going to focus on the 3-way interaction between Moody's and recalibration and rating. Okay, so this is the relationship between ratings for Moody's after the recalibration. And we're going to argue that that relationship should be positive. So they reduce the number of elements, the number of categories that they use in the rating system, and that's going to make that relationship between ratings that they do issue and the yield more pronounced. Okay, so let's see what happens. So when we go to the data, what we do in fact find is that we have a significant coefficient for beta 1. So in other words, after the recalibration, there is a more pronounced positive relationship between the rating and the yield. Again, consistent with a fairly subtle prediction from a cheap talk model. With S&P in contrast, S&P, you can also see, as we discussed in the context of H1, that relationship still exists. So the relationship exists for S&P bonds. What's interesting is after the recalibration, it's even more pronounced, as we had hypothesized, for the Moody's rated bonds. Okay, a robustness test, just for a second or two. Robustness test. So here, it's been argued that institutional investors have superior ability to assess bond risk. We also argue that they are more likely to be able to assess the strategic reporting incentives of the rating agency than retail investors. So we would therefore expect a positive association between ratings and dispersion for institutional investors, but that relationship should be weaker for retail investors. We define retail investors as those investors that restrict trades to less than $100,000 per trade. And what do we find here? We find that if we look at the institutional investors, so that's the middle column, and then we look at retail investors, that's the column on the right-hand side, we find that as we had predicted, if you look at beta 1, the coefficient on the triple interaction between Moody's, recalibration, and rating, that relationship for the institutional investors is positive. So they recognize that credit rating agencies are strategic. In contrast, when we look at the retail guys, they behave as if the information is verifiable, just as we had hypothesized. What about if you just look at the relation, and that of course is after the recalibration, but what happens if we look at the relationship between the ratings and the dispersion just across the sample period? And here you find, here we'd add up the coefficients for beta 1, for beta 2, for beta 3, and beta 7. In other words, all of those independent variables that have ratings in them. And here we find, if it's a cheap talk model, it should be positive, and indeed it is for the institutional investors, and it's significantly positive at the 5% level, whereas for retail investors it's not. Again, suggesting that retail investors seem to look at these credit rating agencies as if they are verifiable information, quite different from the sophisticated institutional investors. So let me conclude, and then, or maybe let's take questions, and then I can conclude at the end. Emmanuel? So how about I keep the slide until the end?
Yeah.
If that's okay with you? Okay.
Thank you. Thank you, Phil, for your presentation. Let's jump to Q&A session. So the first question is from John Zhou.
Aloha, Phil. I enjoyed your talk. It's not a cheap talk. So my first question is, are the credit rating agencies giving out the favorable ratings for client relationship?
So is you asking, do they email?
No, my question is, you see I'm talking about the incentive of credit rating agencies of giving out favorable credit ratings.
Yes.
Are they giving out these credit ratings for client relationship business, client relationship? For example, to give these ratings so that they can get future business from clients.
Yes, that would be the incentive, and that's the feature that we had in the model. Remember, the feature in the model was we had the objective function, and let me share it with you. So if we look at the objective function for the credit rating agency, what we argued is, if you look at that expression towards the bottom of the slide, you see beta, B, which is the amount of the incentive alignment times the bond price. So we recognize that they are trying to boost the bond price by offering more favorable ratings, so as to carry favor with the municipality or the corporation issuing the bond. And we have work consistent with that. So okay. I think of work by Jacqueline Gillette et al. They argue that that recalibration was beneficial to the municipalities because it allowed them to extract greater rents from the issuers that they were rating.
Okay.
So that's a fundamental feature of our model.
Yeah, yes. Okay, that's great. My second question is this also related to competition concern? I still remember when I watched Big Short, when they talk about the credit rating agency, they are saying, if I don't give you a favorable credit rating, you're going to go down the street to another credit rating agency. So yes. is there any kind of, how is computation concern kind of incorporated in your model?
Yeah, that's a good point as well. I think, just very abstractly, that competition concern, so this really concerns the CRAs. And in fact, these credit rating agencies even advise corporations and municipalities how to get a better rating. So it's to encourage them to attract their business. The way I would capture that in the model is just to suppose that the B parameter is larger. So in other words, the interests of the credit rating agency are more aligned with the issuer. They're more beholden to that issuer to try and win that business. And in context of the model, what that means then is that you would have fewer categories that would be offered in equilibrium. So rather than having 10 categories, you might only have 5 categories if there was a great deal of misalignment between the interests of investors and the rating agency. And this is why this is a motivation for the study, and this is and why I feel really strongly about it. And I was so glad that I had this opportunity to share this with you. Cheap talk, unverifiable information is really fragile. And when you have these conflicts, like opinion shopping or guiding issuers as how to get the best rating, it really destroys the ability of the credit rating agency to be able to communicate with investors. And if you're a retail investor that doesn't recognize that strategic behavior, you get harmed by this, as our research shows. So that's why it's with great interest that we look at this debate or the investigation and the task force that the SEC has formed to investigate this issuer pay model, because we've got to align incentives if the information is unverifiable. If it's verifiable, no, you can have misaligned of incentives. Like auditors, they get paid by firm management, but there the auditors have to disclose in the audit report what the compensation is. And that ensures that we are aware of the misalignment. But still, as Milgram and Grossman showed, you can communicate and fully reveal information in that setting. In a cheap talk setting, even though I know exactly what your alignment is, I don't get full revelation.
Thank you.
You're welcome.
So the next question is from Miguel. He seems to be very eager to learn about your paper, given that every other question is from him.
Hi, Phil. This is Miguel. Well, it's not that I sort of like have every question. We have a PhD seminar preparing for the actual seminar, and then our students were very active yesterday. Emmanuel is also part of it, and several of these questions came up. So I'll let them ask some of them if they want. But my main sort of in terms of positioning, I feel that this study can be seen in 2 ways. And I don't know which one will be more beneficial or which one would you prefer, but currently the paper is in between. Is whether this study is about having a theory about how the bond market works with respect to cheap talk, and then applying that theory to the setting of the recalibration, or perhaps in a more tame way, but simpler in terms of publication, perhaps, is there's this phenomena that is very interesting, the recalibration. So we're gonna develop a cheap talk model to make predictions about the recalibration. So you see, they're not exactly the same thing. Is I have a theory and I find a setting versus I have a setting for which I develop specific predictions.
Yes, a very astute comment. Yes, Miguel, in fact, just yesterday, Pei and Leo and I were debating exactly this issue. H1 applies to any credit rating. It need not be municipal, it could be corporate. And you could examine that for many, many, many years. You could have a huge sample of data. But that we didn't think was as subtle, because one could argue that with the recalibration, you just, the Moody's didn't use the lower ratings, and so they just shoved all of these issues into the higher categories. So you would be able to get H1 with a very large sample of data, but what you won't get is H2. And H2 is a subtle prediction of the cheap talk model. It's not a prediction that you would get if you had a verifiable information model. And so we view H2 as being the best evidence that we can offer that information is cheap talk. And we find consistent information with H2. Because, you know, as a theorist, you've got to be really careful telling regulators what they should do. I suppose even as empiricists, we should be quite careful telling regulators what they should do based on the analysis that we've done. And so we wanted to be, you know, bring the sharpest test that we could. And because we want to separate between verifiable information and how you regulate that versus unverifiable information and how you regulate that. And so we wanted to bring the sharpest test that we could. And that's why we doubled down on the 2010 recalibration.
Miguel, you're muted.
So then my recommendation will be then that instead of choosing either or approach, to explain that in the paper, right? That both the theory and the findings can be used to learn broadly about the bond market in terms of theory building for the bond market, and perhaps more specifically to the issue of recalibration. I think both you don't necessarily need to choose, but it would be good to have that on the paper.
Yes, I agree with you.
Respect to the second approach, where you are going to make specific predictions about the recalibration, I feel that, although I really like the institutional background in section 2, that there are a few things that you can explain perhaps more cleanly and directly. Mm-hmm. One is that the recalibration resulted in narrowing the distribution and moving up. So if you look at the bars, what happens is that now you have less, so everything is so compressed, but it's also compressed and move up. And then the second thing is that about the verifiability, I think not everybody is very familiar with what's in the Muni bond pool. The Muni bond pool is not just cities, right? There are cities, hospital, fire departments, dams, and universities, and highly unverifiable, because information about these issuers is not widely available, right? So I think that's very, very important to say that this market relies more on ratings than any other bond market, perhaps, right? Because information is not easy to obtain, and there are not as many bond analysts in this space as you will find in the traditional corporate bond space.
We agree exactly. We first of all ran our two designs focusing on general obligation bonds, and there tends to be a little more information available, and we get results very much consistent with the results that we're offering here. And then we expanded the sample to include not only general obligation bonds, but those other bonds that Moody's rates according to this municipal scale that you mentioned, sort of these public works bonds. I mean, private universities, public universities, toll roads, etc. And we get the same, very much the same results when we expand our sample. And so the data that we see here, and the results that I shared with you today, are for all bonds that are rated according to this scale. But your point is well made. I mean, some of these issuances, they're very difficult to verify. And so there's even more reason to think that the talk is cheap. But how do you, if I tell you talk is cheap, how do you empirically show me that?
Well,
and I think that's the nature of the study.
But that's why I guess when you say it's unverifiable, that seems like a very strong assumption. So I think I would like better saying is largely unverifiable, right? Because these are long-term bonds, because there is no information, because you can verify something, right? And that's going to be my last question. There is a high degree of conservatism in these bonds because type 1 and type 2 error have different costs. So a low rating, a rating that fails to predict a bankruptcy is way more costly than a rating that predicts no bankruptcy well, right? So, and given that asymmetry, Moody's is very careful of having always a very few bad bonds, and then most of the rest in high sort of buckets of the distribution, right? So there is some degree of verifiability, right? If a municipality goes broke, which is unlikely, they have ways in which people can find them out wrong. but not so easy. So I don't know if what will happen to these cheap talk models if you include some partial degree of verification?
Yeah, very good question. Miguel, we wanted to offer the most basic cheap talk model and contrast that with the most basic verifiable information model to make the hypotheses as sharp as possible. It's true that you could think of degrees of verifiability. There are all sorts of issues that we could introduce. I mean, there's some question about, what are the incentives of the credit rating agency? Just how misaligned are they with the issuer? And of course, these issues have been examined within the context of theoretical cheap talk models as well as theoretical verifiable information models. So it's an empirical question about how well-grounded our hypotheses are. And I think when you look at, so for example, if you look at the split between the retail and the institutional, you get such striking observations. If I offered hypotheses that were some more nebulous, I'm not sure if I would be as passionate about trying to present these results to you.
Sure, thanks. I'll pass the questions to somebody else.
Thank you. So our next question is from Rosie.
Hi, thank you, Phil, for the very nice presentation, and I really enjoyed reading this paper.
Thank you, Rosie.
So here I have two questions. The first question is, I'm wondering whether the information in the natural experiment is actually verifiable. So I'm thinking that because in the natural experiment, the intent of the recalibration is actually known to the investors, meaning the investors know that the recalibration is to align the rating to the global rating scale, and this increase does not really contain any information relevant to the bonds fundamentals. So I think this information therefore cannot mislead or misguide the investors. So does that mean that the information in the rating increase is actually verifiable? So that's my first question.
Rosie, can I tackle that question first, and then we'll tackle your second question?
Yeah, sure.
Thank you. So with regard to that question, you might change the rating scale because your interest became more and more misaligned or more and more aligned with the investor. So for example, if there's a great degree of misalignment, you might only be able to offer a 3-category ranking, as we'd see in, for example, in the case of equity analysts, where they have buy, hold, sell, for instance. Okay. So the number of ratings that you can offer in equilibrium in a cheap talk model is a function of the alignment between the credit rating agency and the investor. We would argue that 2010 recalibration was driven not because of a change in alignment. And it's unreasonable to think that alignment all of a sudden happened on one day in time or over a very short period of time. It was driven because of crossover investors, asking Moody's to use the global rating scale. And this had been coming for a long time. I mean, they thought about these issues back in 2002 onwards, about, the virtues of using the municipal rating scale. So I think, I don't think the fact that we have this change in the rating scale, I don't think that's driven by changes in the level of alignment. I think it was driven by, in other words, the B parameter in the objective function. I don't think B changed over the short period of time. I think it was just an exogenous change in the number of categories that they're using, and therefore this provides a nice experiment within which we can examine how, when you change the number of categories, how it changes the relationship between the message that is sent and the actions that it induces. In other words, the dispersion in yield.
I see. Okay, thank you so much for the explanation. Yeah, I also have a second question. So I'm wondering whether the results that you find can be alternatively possibly driven by the cross-sectional differences in the bonds fundamentals. So before the recalibration, we can think of like a high rating group mostly consist of good bonds, and low rating group is mostly consist of bad bonds. But after the recalibration, the high rating group now becomes a mixture of both good bonds and bad bonds. And the low rating group is still consists of bad bonds. So now what you find the standard deviation of the like the dispersion of the yields is actually driven by the cross-sectional differences in the bonds fundamentals within the high rating group. So that's possibly causing the dispersion.
Okay. Rosie, possibly, but let me just go to H1 and think about H1. Okay. So that was a hypothesis that said as bonds ratings become more favorable, dispersion increases. That holds for S&P. S&P didn't change their rating scale, and yet you continue to see that positive relationship. So you were pushing on the recalibration. And you know, of course, I could argue that point as well. But I think you would have, if you don't believe the cheap talk model explains this data, then how would one explain the relationship that you observe for the S&P rated bonds, for instance?
I'm just thinking that whether the standard like the dispersion in the yields is a good measure of informativeness in the rating. So maybe you can use alternative measures such as trading volume, because if you use the standard deviation, right, so it can be causing by the cross-sectional differences rather than whether the investors have diverse opinion about the increase in the rating.
Yeah, Rosie, good question. In this work, in robustness tests, we also look at we adjust the yield for treasuries, and so we look at the yield spread, the dispersion, the yield spread, as a robustness test. And then in an earlier paper, we also looked at the range of the yields. Because if you look at this picture here, you can see how, as the ratings get more favorable, you can see how the range in the yields gets higher and higher. And we find similar results if you look at the range in the yields. It's just that if you look at the range in the yields, that prediction is much more sensitive to assumptions about the underlying distribution. It's very much more dependent about whether you think the credit rating agencies are engaging in a cardinal or an ordinal ranking. And so because we didn't want to rely too much on the underlying distribution, we therefore focused on the yield dispersion rather than on the range of the yields. But we do, in this earlier work, we did get results consistent with this. So there are other measures that you can use, and you'll still find support for the cheap talk model. Okay,
very good. Thank you.
Thank you.
Thank you. So the next question is from Miguel again. Although I think you already asked that.
Yeah, I'll pass on my questions. We will send you the chat, and also we usually go back to a document that we generate with the PhD students. We add more of our concerns, something that happens at the seminar, and we usually send it to the presenters in the middle of the following week.
Thank you. I'm shocked that you have concerns.
Well, there are no concerns there. I actually like your paper a lot. Your paper is about a real thing. That's what I keep telling the PhD students, write papers about real things. But I'll give my time to somebody else.
Thank you, Miguel.
Thank you. Well, actually, I had a quick more suggestion, not a question, for your H1. So if you were to look at corporate bonds, you also have a nice setting. So the corporate bonds will be, of course, more verifiable. They have more information. But even with that, with the for these bonds, you have different degrees of verifiability, right? So you have maybe smaller firms that you know less about. You have firms with more, less analysts following, firms with more or less cash, things like that. So that can give you sort of like nice cross section when you can try doing something similar for your H1 especially, right? That's just a suggestion.
I think that would be fascinating. It goes to the point that Miguel was raising earlier about, why have you got H1 and H2 and why you focused on the recalibration? And the reason is because we're looking at H2, which we think is quite a subtle manifestation of the cheap talk prediction. But there's no reason to think that this cheap talk model wouldn't apply to corporates. And I think that would be an interesting extension or additional work that one could do. And the prediction is clear. I would apply H1, and I would say that as the bonds get more favorable, so the yield gets higher. And that's a stunning result. Because, I remember talking to Rafael Laporta when I first started thinking about this problem. And he thought, no, his prediction was that as the ratings get more favorable, yield should go down. right? Because it's a high-rated bond. How could there be anything wrong with it? There shouldn't be much yield. And that's not what the cheap talk model is predicting. So if that results in the corporate environment, I think that will be helpful, because we need to know, is this information verifiable or is it not? Because that's going to affect what regulators do. And it's got profound implications for how we regulate. I mean, this has been the advantage of information economics over the last 30 years. We're now in a position to say how you should regulate based on the properties of information. But it's an empirical question then for us to determine what those properties are, because it has very different regulatory prescriptions.
I agree, yes. Yeah, it's very cool. All right, thank you. So next question is from Emmanuel.
Hi, Phil. I know you want a couple of minutes at the end to conclude, so I'll sort of make this quick, or you can just cut me off and I can send you an email.
So take your time, please.
So I was just trying to wrap my head around verifiability in this context, and I guess I'm stuck thinking of verifiable information of something we can true up ex post. But here it seems like that's not the case, and it's obviously due to the coarseness of the signal. So it seems like it's a perceived, is it verifiability based on sort of legal protections of the credit rating agencies? And something else I can't sort of separate in my mind is this has to be related to the investor sophistication, which gets to the retail investors versus the institutional investor results that you show. So yeah, I don't know. I'm just thinking, how do we, like, what exactly do we sort of mean by verifiable in this context? And is it really a function of the investor sophistication?
Yeah. Emmanuel, that is such a good question. And I've struggled with that question for 20 years. I can offer you a theoretical manifestation of what I mean. If you look at a cheap talk model, so on that expression on the bottom of the screen, notice that we have in the first term, the credit rating agency wants to push up the price of the bond so as to curry favor with the municipality issuing the bond. Notice if you look at that quadratic term, it's a function of the difference between the action that is induced in the mind of the investor and then the underlying state theta. So that's a characterization of a cheap talk model. That's non-verifiable information. The words you use don't have any meaning. All that matters is the action that you induce on the part of the investor, and that affects the payoff of both players. Now, if I'd offer you a verifiable disclosure model or a costly signaling model, like if you think about Fisher and Verrecchia, where, the 2000 paper, those were there was a cost associated with the message that you used. And that model would differ in the quadratic term. You wouldn't have P of the rating, you would have the rating itself. So in other words, when you offer a management forecast and you say the earnings are going to be 10 cents a share, you would put 10 cents in there in the cost function, and you would subtract whatever the true underlying was, because the words that you use have literal meaning. What meaning does AAA have? In fact, the rankings aren't even that useful. There's so much excess letters in all of these rankings. I mean, you look at Moody's rankings, and they have AA1, AA2, AA3, BAA1, BA, all these A's. I mean, how about just being succinct here? So clearly, the words don't have any literal meaning. Just like when we grade our students, A, B, C. And we've got grade inflation. What do we think about A, B, and C? It doesn't have any literal meaning. So all that matters is the action that it induces on the part of the receiver. So when we think about unverifiable information, you don't think about the information itself as having any literal meaning. You think about how it affects the beliefs of the person hearing it.
All right. So then, just to push a little bit, then it is, if it's going to affect the actions through the beliefs, then to some extent, does the sophistication investors come into play?
Yeah, because how do they update their beliefs? And interestingly, institutional investors seem to recognize that this information is cheap, whereas the retail guys take it as verifiable information and then are misled, it seems, by it. Is there a trading strategy? We haven't gone there, but they seem to be misled.
Thank you, Phil. So we'll give you, we're almost that time, but we'll give you that last minute to conclude.
Okay, thank you. So let me just conclude with just summarizing what we do, we have two primary hypotheses. First of all, we argue that as the ratings get more favorable, so yield dispersion is going to go up. We do, in fact, find that for the S&P rated bonds over the sample period, and we find that for Moody's rated bonds after the recalibration. And then there's a more subtle hypothesis of the cheap talk assumption. We look to see whether after the recalibration, the relationship between the rating, the favorableness of the rating and dispersion was more pronounced, and in fact we find it is. So this then is consistent with credit rating agencies offering unverifiable information, but not verifiable information. So what's our take home? Miguel, as you were pointing out, the properties of information are really important for how we regulate markets. And if the information is unverifiable, then we would argue the focus has got to be on ensuring that there's alignment of incentives by, for example, revisiting the issuer pay model. If information is verifiable, then we need to ensure that the unraveling argument in Grossman and Milgram applies. In other words, we need to ensure that we know what the incentives are of the analyst, the credit rating agency, by, for example, disclosure, as we see in regulation best interests. And then what regulators need to do is try to reduce things like disclosure costs, because as Verikia argued, those would prevent the unraveling argument from applying. So that's all I got.
Right. Thank you very much, Phil. Thank you for sharing your research. Great presentation. Thank you, everyone else, for joining our webinar. If you have any question or comment, please send them to the authors, and hope to see you next week. Have a nice weekend.
Thanks, everyone. Thank you so much.
Cheers.
Cheers.